Hello, everybody. This is Jose Blasco. How are you, everyone? We're about to get started in 40 plus seconds. This is a sound check, so that way we start perfectly on time, knowing that sound is good. Can you please go ahead and type on the chat box a quick hello? That will tell me that you hear me and that you're ready to get started and that sound is good. Please do that. This is our normal practice, isn't it? Let's do that so we can get started. Thank you so much. 20 plus seconds and we go. Hey, Mark, good to see you. Joe, good to see you. Five seconds to go. So it's basically time to get started here. Wonderful. Perfect. Top of the hour. Time to get started. Welcome to the session, everybody. Today is October 6, 2022. My name is Jose Blasco. This is Options Trading Live. Before we get started, as we begin, I would like to highlight on the upper left our financial disclaimer. Please read it carefully. It is important information. It is fairly short, and therefore I'm counting on you all to read it completely. It's important stuff. Thank you so much. Jeff, how are you? Good to see you. It seems that you had some problems yesterday to log in, but nice to see you're with us today. Very nice. So again, for the ones of you that are new to the session, when we run the options trading sessions, obviously we trade options. And the way we do it is that we first look at what's happening in the market. We review trades that are running. We manage those trades if needed. And from there, we move into looking for new opportunities. Talking about trade management, today is going to be quite special because last week, I was not able to run the session. And therefore, we missed a week of rolls, which implies that I got assigned on shares, which I left it alone on purpose. So today we can talk about it. If that was to happen to you, how to do it, etc., etc. So I'm going to be able to talk about the whole process on how to manage those trades in case you have been assigned. And I'm going to be able to show it on the screen because, I have trades where I have a combination of options contracts combined with shares of stock as a result of assignment. So again, hopefully a great experience, great exercise to do together. Okay, so I let it happen like that on purpose. Joe, yesterday, not sure what you mean by yesterday. I'm not sure. Not sure. If you could rephrase that would be great. Okay, so let's get started here. I'm just going to close our introduction slide and jump into the platform and begin our analysis. Okay, so first, I would like to look at the VIX, the Implied Volatility Index. Okay, so not like that. VIX. Okay. What's happening? Okay, now. Not sure how I was typing it. So the VIX. So what do we have yesterday? Oh, I get you. To be honest, I think I said that wrong. I probably meant on the prior trading day. That was on the prior trading session. That was Tuesday. You are correct. You are correct. Let me edit the probability cone because I think I have disabled. No, it's all good. Okay, good. Okay, so the VIX, what do we have here on the VIX? Okay, well, you can see if I get a few more candles on the screen, that low for the VIX in this particular time frame is around 19, high for the VIX is 30 plus. We are currently trading at 29, so it's not low, it's not expensive either, but certainly it's slightly above, let's call it the midpoint. So definitely, if you were to choose between being a buyer of options or being a seller of options, being a seller of options would make more sense, isn't it? In any case, we're going to have to look at specific market opportunities. And of course, as always, knowing that the VIX is slightly on the high side, even though it's not so high any longer, knowing that it's slightly on the high side is certainly useful. But we need to combine that information with what's happening on the S&P 500 index itself, which we normally use the ETF SPY to do this analysis. Got you. Thank you for those chats there, guys. So you guys are basically answering each other. Wonderful. Thank you for that. So what's happening to the S&P? Well, the S&P, it's being a little bit of a teaser in the recent times. It's giving us the impression that finally it's going to pick direction in one direction or another, and then it's not showing enough decision. Okay, so take a look at what has been happening. And again, we missed a meeting on the last week, so if you don't mind, I want to go back a little bit in time to the prior climate that we had when the S&P was showing a red climate. So this climate, statistically speaking, should have lasted by 3 candles, and it lasted by so much more than that. So much more than that. Now, having said that, the majority of this down climate was happening while the implied volatility of the calls was above the implied volatility of the puts, the blue line above the gray line. And that means that there were buyers in the market. Of course, remember when we use the DT volatility comparison tool to analyze the options markets, we can easily conclude that there are buyers or sellers in the market, depending if the blue line is above the gray or the gray line is above the blue. But it doesn't tell you at which price. Okay, to understand which price, that's when we use auto climate, we use the auto UFOs, etc., etc. So there's been a big fight, okay, right? Because the climate kept, the market kept falling and falling and falling and falling, but that probably was the recipe to add more and more and more buyers into the market, more and more smart investors probably that were deciding, you know what, this is becoming so good for me to buy it. Okay, and how are you, Ahmed? Good to see you, my friend. And therefore, while the climate kept lasting for longer, the reality is that shorting was not a good idea because apart from being very stretched, we had evidence of buyers in the marketplace, and that evidence, when you see the size of this blue bar, you see the size of this blue bar, or especially this one with a huge gap up. That can only be formed given the fact that there were significant amount of buyers in the market, because given the size of the impulsive moves to the downside, having such a high speed of movement in the opposite direction can only be happening because many buyers were entering the market. So again, the blue line was telling us the reality of what was happening, but as everything in trading, it's all about timing. Therefore, acting to go long could not be done. Of course, there are many ways on how to trade it. I'm obviously assuming that you use auto climate, auto UFO, you use our rules, you use my rules. So if you were using the same rules I have in my trading plan to trade, so you would not have got long, even though we had evidence for a while that buyers were in the market, you would have not gone long in any of those places. Okay, you would have waited for a change of color in the auto climate analysis technique, which took place a couple of days ago. Now, why am I calling the market a teaser? Well, I'm calling a market a teaser because we still have buyers in the market, blue above the gray. So, and the climate is blue, so time to be a buyer. But the problem is that the climate is not confirmed. We have a thin dot. We don't have a thick dot like we had here or here. And therefore, this climate is not providing a statistical advantage just yet. So, non-directional trading, obviously, it's going to be the way to go. Again, I'm always assuming, let's say you have no trades in your account and you need to take one. So, iron condors, my friend. The VIX is slightly high. The market is not decided from a direction from a directional point of view yet. The climate is not confirmed. So what do? Iron condors, okay, and keep collecting premium while we wait for market condition to define itself and be more aggressive with the deltas. Right now, no time yet, because again, based on the analysis I just done, the market has not shown enough statistical decision for the climate to go from unconfirmed to thick dot confirm. So we have to respect that, even though it's a little bit of a pain to use so much of our patience, but that's how you don't get in trouble. Okay, we know that one of the most important time that trader will spend is actually not trading instead of trading. So it's absolutely key, and it's a normal thing in the life of a trader to be very, very patient. Okay, and this is a situation that obviously invites for that. Now, having said that, again, we may have a bit more of a serious continuation to the upside, and the moment there is a bit more decision shown on the market, we may have a different measurement on the auto climate tool, and now we got permission to be a buyer. Okay, or maybe we're gonna have, to be honest, we have a potential Elliott wave turning point today. I call it potential because we don't know until the candle closes. But if the candle closes the way it is, we have a potential Elliott wave turning point with a target located around 350. So we may need to see a change of climate to go red, 3 candles on the way down, and then come back higher, and then here we go, right? And that would be technically a double bottom. Whatever, we'll see what's going to happen. But the fact is that we have buyers in the market, which is something that we didn't have the last time that we had a blue climate. We had sellers in the market at that time. So it's all about playing the patience now, waiting for the market to confirm itself with a climate to be confirmed, while the options data confirm there are buyers in the market, and then find good opportunities and be more confident with more stats in our favor to take those longs. So far, non-directional trading is going to be the approach because of everything I've said. So before I keep going, I'd love to get a little bit of confirmation from you guys. A quick yes, a quick okay on the chat box is okay. If you want to have a lengthier, I'm missing words today. I'm not sure what's happening to me today. If you want to have a little bit of a longer kind of like, sharing of your point of view, for sure, go for it. Or if you have questions, of course, okay? But certainly I'd like to know that you are with me because, from here, I'm going to start planning on the trades, okay? Good, perfect. Thank you for that, Ahmed. Okay, great. So let's go for it. Okay, let's go for it. We're gonna look at our positions first, and from there we'll move into identifying. Mark, I would prefer to do iron condors. Okay, I would prefer to do iron condors because the VIX was not low, so doing iron condors would be a bit more advantageous. Okay, again, remember when I mention what I just said, I'm always thinking, because everybody got a different portfolio, right? Everybody got a different account with different positions that you entered at a different time. So because of that, it's difficult to be concrete for everyone's case. So if I am a bit generic, the best way for me generic is to say, okay, let's pretend you got nothing in your account. So given the VIX today, given the S&P today, iron condors, okay? Doing double calendars, sorry for my voice, it's not the best idea because the VIX is not that low. Could you find valid opportunities? Of course, but it gives you a bit more of an advantage if the VIX was lower to do the double calendars, which is not the case today. So we're going to go for iron condors. Okay, now a totally different story is, let's say you already got 3 iron condors in your account. Let's say you already have some directional positions that have not only deltas, but also vegas and thetas associated to them. So then you would look at your overall portfolio Greeks, and depending on what your portfolio have, you may be like, you know what, I want to add positive vega. And if that's the case, then you would do a double calendar, because a double calendar is non-directional, which is, totally compatible with my analysis of the S&P 500 index. So it's non-directional, but instead of negative vega, like an iron condor, it's positive vega, like the double calendars. So if you needed positive vega, that's what you would do, okay? Again, my assumption is you have nothing in your account and you want to add a new position today. So iron condor would be the best way to do it. Sorry, guys. Yeah, sorry. I may have to excuse myself a few times today. Unfortunately, my throat is not doing too well. Anyway, so what do we have here? We have new core is one of the positions that we have been running. If we look at new core and we look at the probability cone, here we go. So here's new core, here's the probability cone. So where are we at? Well, if you recall, okay, so this trade started on that particular day, right? We did a double diagonal using that particular set of strikes, 150, that particular set of strike, 125. And then this market started moving down like crazy, right? Much more than expected. Again, of course, we find our UFOs even before getting to the red line, and now the market is moving in the opposite direction, so that's very nice to see. But still, we have surpassed the 125 strike, which is, again, not something that you would expect to happen too soon. And it happened. And again, that has a lot to do with the fact that the S&P was impulsing very, very strongly. So if you recall, in prior sessions, we talked about the fact that you could narrow the size of the range, and that's why I had this new red line combined with this new purple line and all of that. Okay, but in any case, putting on the side that you could have done multiple management actions, which I discussed in prior sessions, and that you have been rolling every week. My situation, if I bring in TOS here and I look at new core, my situation is that notice what I have. I have the 150 call, I have the 125 put, and those are two options that I'm long. Those are the ones that expire in October 21st. Okay, so in other words, I have not changed my original range in my particular case. I'm still using the 150 strike, which is the upper purple line, and the 125 strike, which is the bottom purple line. So I'm still in that same position. But then notice what just happened there. I am long 100 shares of stock at 125. How come I got 100 shares of stock at 125? Well, because together with the 125 put, which I'm long, I also had a short 125 put that expired last week, which is the week when we didn't meet. When we didn't meet, and because we did not meet, I never rolled the put, so I went into Friday expiration with that put short in my account, and therefore I got assigned, and the 125 put became 100 shares of stock long at 125. So I have the shares, okay? And I know in prior cases we talked about a similar experience that you guys had with other stocks, or that stock, I don't remember now. And we talked about what to do, and you know, again, I'm doing this at a great disadvantage because I could have acted on that, you know, all the way at the beginning of the week. I'm acting on this. Actually, I could have rolled and avoid this problem. Again, problem. We talked about it's not really a problem. It's really a margin impact, but depending on, you know, how you deal with it, it doesn't need to be a problem. It does not add risk. Okay, that's what I mean to say. So in any case, I could have sold premium earlier in the week and you know, mitigate the risk of the trade more, which I have not done. Because again, I was waiting for today since we are meeting today, and therefore I'm going to do it now. Okay, so what is it that we have? Well, what we have is the following. Look, if I take my last new core, which had options that expire on September 30, last Friday, if I right click and go for a risk graph, you will see that out of 4 units, 1, 2, 3, 4 units become 1, 2. Okay, why? Because the risk graph cannot simulate something that does not exist anymore, and therefore the September 30 go away. Okay, the September 30 options, they are gone. They are not in my simulation anymore. Okay, so what is it that I want to do? Well, what I want to do is I want to re-enter that, right? So we're gonna add 2 more legs. Okay, I'm gonna enter in the simulation first, and then we'll enter the trades in the account. I'm gonna be dealing with the 125 put and the 150 call. Okay, this is going to be mid. And for now, I'm just going to click OK. This is not adequate, but I'm going to click OK just to avoid loading the option chain. I just want to find out what is it that we get if we sell the call now. So it seems that the call may pay 11 cents up to 16. So look, the first thing I want to do is I'm just going to place an order to sell the 150 call at 15 cents, which I am only going to get filled. Oh, wait a moment. I'm using the wrong expiration date. Sorry, guys. I should not be using October 21st. I should be using October 14, which is next Friday. Okay, so that makes more sense, and probably is going to give you a worse number. Exactly. So the bid price is 0, right? So no one wants to buy it. If I want to sell it, I could bid whatever I want, but no one is willing to buy it from me. So it's going to be very difficult for me to get filled. Okay. In any case, you never know if the market is going to experience a very strong rally to the upside. So in case that is the case, I am going to very quickly, because that's the easiest part of our conversation, I'm going to load new core, and I'm going to use September 14, 150 call, okay, which is trading at 0. I'm going to make it minimum 0.15. We've done this before, so I'm doing this quick. Hopefully that's fine. If you have questions, stop me, please. Good till cancel, and I'm just going to place this order to take care of the call side because I got nothing on the call side. So at least if the market rallies and I get 15 cents and I get filled, at least I will mitigate a little bit the pain I have on the call side, which we discussed already in prior weeks. Okay, so anyway, so I got this order here, October 14, 150 call, waiting to get filled. Quantity is so far 0. So that's it. Done with the call. Now the put side, is what I want to change. I want to close the shares and sell a new put. That's what I want to do. I want to close the shares and sell a new put, right? So now, if I sell a new put, how much am I going to get? I'm going to get 705. That's the midpoint. Okay. Now that seems like a lot of premium. It's like I'm bringing in $700 of premium. But yeah, it is indeed a lot of premium, but careful, because if I close the stock now, right, that stock is currently trading at 119. So if I close it now from 119 to 125, I'm going to lose $600. So I'm going to lose $600, but then I bring in 700. So I'm going to be net ahead of the game by $100. Okay, so certainly way to go in our process to keep massaging the trade. I could have done the same last week. Again, I missed those, whatever amount of premium I could have brought in, but I'm doing it this week. So how do we do that? So two things. First, I'm going to do the execution. So you see how it's done. But then I need to do the reporting, which the reporting, on the call and the puts that we already had in the account, we had 305 and 446. Okay. So we are about to add these premiums, but by entering the new options that expire on October 14. But we are also about to lose $600 on this trade. So again, at the end we're gonna add $100 of premium. That's the bottom line. But I need to show you how I'm gonna do the math and how I'm gonna re-enter those values, because I cannot edit this. If I right-click and edit this, as you have seen, the 4 legs become 2 because the September expiration cannot be simulated because they don't exist any longer. Okay, but that's the nice thing about the My Position window, is that it keeps that information in a way that is recorded, so you can now recover it and use it on the screen. So I'm going to do that in just a sec. But first, let's do the execution. And even before that, let me take a look at the chat box, because I see you guys are typing. Joe, the VIX is high. Yes, absolutely. And I believe that this is a comment that you're probably interacting with Mark there. And definitely yes. Joe, would you use UFOs and the VIX to add to the strategy decision? No, I wouldn't. And the reason why I wouldn't is because it makes it a bit too complicated. And it would stop me from trading at times. So let's say, for example, the VIX is somewhere in the middle, UFOs, in between UFOs. And it's the time where I'm in front of my computer and I have a good trade set up with the stock, but the VIX is in between UFOs. So I get stuck and I cannot trade. So now, is it a good rule to have? Is it a good idea, the one you're sharing? Yes. If the stock was to meet your entry and the VIX was to meet a UFO, even better, right? But I don't use it, and I would say it's a bit too much of looking for the sure thing, I would say. A bit too much of perfectionism, which I understand you, Joe. We talked about this before. I'm the same. And the reason why I'm saying it, I'm coming from a pragmatic point of view. This is going to stop you from trading many times where you want to trade. And the VIX is something that, first of all, we are looking at the VIX, which is the average implied volatility for 500 stocks in the S&P. The stocks you trade may not even be, part of any component of the S&P 500 index. And on top of that, stocks have their own implied volatility, which may be way more extreme than the VIX. So the fact that the VIX is in a UFO certainly helps, but it doesn't mean that much to an individual security. So we are just using it as a reference, okay, for what to do if you got nothing in your account. But again, when you are dealing with individual securities and so on, the implied volatility from that particular security is way more important than the VIX itself. So long story short, I would say no need, even though, of course, if you do it, it's definitely not going to hurt you. You're just going to be able to trade much less compared to if you ignore it. Okay, good. Mark, if one has the money in their account, why not just wait until you have a profit on the new core 100 shares? Because you are not guaranteed this is going to happen, Mark. You are not guaranteed this is going to happen. And if new core keeps falling, then you're just going to have the maximum loss that the strategy provides, which is limited and it's okay, but you're just going to get that. But if I keep massaging the trade, I reduce my risk by $100. So worst case, I reduce the risk. But also, if the stock does go back higher, which is your hope in your comment, Mark, if the stock goes up higher, then your double diagonal will actually pay you as well. It will pay you less than if you were to own the stock, but it will still pay you. And of course, you reduce the risk, so you reduce the payout if it goes up. But if you don't reduce the risk and it goes down, then you lose more, right? So it's a trade-off. And again, based on the philosophy of how we massage the double calendars, based on how I've been leading you on how to do it, based on my teachings and so on, the concept is reduce the risk every week and give the trade a second chance if things go bad. But always reduce the risk. Never be happy with sticking with your risk, and definitely never, ever, ever increase your risk. Okay, that's the philosophy of the management. Again, you are not adding risk if you do what you're suggesting, Mark, but you are not diminishing the risk ever. Sorry, I'm not sure what's happening to my English today. You're not diminishing your risk either, and that doesn't work in your favor. Okay, based on the philosophy of the management. Cool. So I love the questions, guys. I love the questions because that means that you guys are doing your homework, you're practicing the trades. I love it. Great, great, great questions. So let's do the execution. So first thing I'm going to do is I'm going to kill the shares. Okay. Why? Because if I enter another short option, it's going to use a lot of my margin. And since I am long shares, which this is already using a lot of my margin, well, again, depending on the size of your account, maybe it's not an issue that you sell the put first and you buy the stock next. But for some traders, that may trigger a margin call if you didn't have enough margin. So we're going to get rid of the shares first to free up margin, and then we're going to sell the put. That's going to be the sequence I'm going to use. Now, to minimize the amount of time I don't have shares, what I'm going to do is I'm going to prepare myself by entering the order here. Okay, so sell -1, sell 14 October to 125 put. It seems that we may get 690 for that. So I have these ready. I'm going to come back here in a moment and click. In the meantime, back to my positions window and right click on the shares themselves, create a closing order. I'm going to sell 100 shares of new core. Here is suggesting limit price. The bid is 11.32. The ask is, not 11, 119.34. The ask is 119.41. So there is like a little bit of a spread on the stock itself. Okay. So, as always, even though it's not an option, I'm going to try to get, somewhere in between. Let's say if I get somewhere in between. And if I don't, look, speed of the light, I'm going to convert that into a market order because what I want to do is I want to get filled. So the market is 46. I'm asking 44. Okay, again, a bit of patience and you may get it in a real account. But again, I don't have patience. We have lots of things to do. So I'm just going to bump this up and see if I get it. $147, $145. Not getting it yet. There's maybe a couple more cents will do it. Let's do it. 50. That's it. I think I'll get it like that. And if not, I'll do a market order, which I guess I should have to save time. Okay. Again, when you do your trades, you guys take it easy. You don't need to rush it like I'm doing. I just want to get filled so I continue with the execution. That's it. I got filled at 119.46. Thank you very much. And now I'm going to go back to my trade tab where I went away. Okay, so let's do it quick. 125, put 670, confirm and send. October 14, yes. So I am now waiting to get filled at 670. I just got filled at 690. Okay, just got filled at 690. Okay, so we got the stock and we got the put. So now let's do some math. Let's do some math here. So we got the stock put to us at 125, and we just got rid of that stock at 119.46. So by doing that, we lost 554. Okay, so I should have done the math differently. So 119.46. Sorry, 119. Minus 125. We lost 554. Okay. Now, while we lost 554, we just collected $6.90 on premium. That is $136 that we are now using to reduce the risk of the trade. So this is now the premium that we just added. Okay, so now if we go back to our positions panel on inside top, on the put side, up to this point, we had accumulated 446. So in other words, to the 446 we had, we are now adding 136. So the total amount of premium collected from those puts is 582. Okay, so in order for me to simulate that on the put side, I'm gonna add 582. That's what I just said, right? Yes. If I do that, this is now going to simulate the total amount of premium brought in thanks to the puts. And when it comes to the calls, so the calls brought in 305. So I'm gonna do the same thing. Sorry, guys. I went too fast there with my keyboard combinations. 305. Okay, and when I click OK, now when I have the resulting position, okay, which is a position where now the most you can lose on this trade is 278. Remember that we started, I believe it was $1,000 of risk, so now it's 278. And again, we are now approaching earnings, which is something very important I need to check now, and take a decision about things. Okay, so far this position, the net P&L of this position is 159.5. Okay, that's the net P&L of this position. And of course, if the implied volatility rallies, we're gonna start making a profit. Okay, but notice that because that stock went so much against us, and of course we could have narrowed the range, which I discussed in a prior session. We could have improved that and not to have this dropped in the red zone in the middle. But it doesn't matter. This is a position that because it went so much against us, we need to manage. So if the stock goes back higher, we're gonna end up in this green zone, and it will be time for us to take a smaller profit and get out. Okay, unless we get to see volatility to rise in a significant manner, we're gonna have to act in a similar fashion to what I just described, given the fact that we are a little bit at a disadvantage. I am indeed, because I didn't roll the prior week, and in any case, just because the stock went so far away from the midpoint of the range, that always hurts. We've seen that before, isn't it? But in any case, worst case, 278 is the new risk for the trade, which is the right way to manage it. And I'm just gonna paste it here. So we have it. So I have a couple more confirmations and checks to do on Nucor. But before that, I'd love to get some of your feedback or confirmation on the chat box or questions. So I know all is good. So Mark, if one has the money in their account, okay, got it. Mark, I rolled the Nucor 125 on Tuesday for 135. Good. So you got 135 and I got 146, right? I got 146. Why did I get more than you? I guess because the stock is a bit higher. But do you notice how much more than you I got? It's not that significant. So I remember in prior questions, I don't know if this is your point or not, Mark, but I remember in prior sessions, you were concerned about maybe doing a roll when it's not the right time and waiting and kind of trading the move of the stock, trying to maximize the profit on the roll. And guess what? Because we're using weekly options, and because options will always have less delta unless it's the expiration date compared to the stock shares, it's not going to make that big of a difference if you are, unless you're super far out of the money or super far in the money, it's not going to make that much of a difference if the stock goes up or down a bit more. So again, I did mention and suggested not to be perfectionist with that approach. And also the other reason I just mentioned a moment ago, which is, okay, you may be waiting for the stock to go higher so you have a roll, but what if it doesn't? And then you never roll, and now it's Friday, right? You missed a whole week of premium, and it's just because you were waiting for a better time. So roll when you have to roll. That's basically the rule, okay? Cool. So now, last comment on Nucor. So this is our expiration date, October 21st. This is our earnings date. It's happening right before. Okay, it's happening right before, on the 20th. Now, this may change. it is not the first time that 1 week before earnings or something like that, they change the date. And if they do that, it's going to hurt. So we need to be watching this. Okay, we need to be watching this. And definitely next week, when it comes to rolling the 125 put we just got that expired October 14, the sooner you can roll this, the better. So you can lock in the premium from the next expiration date. So if they change the date, it doesn't hurt you. Okay. One more check. Time goes so fast. So if I look at October 14 and 21st, right? And we look at the anti-money strike, for example, implied volatility is 52 on the current front week, on the next week, sorry for that, 8 days to go, and it's 53 on the week after. It's more or less the same. So we should get a nice increase on the October 21st expiration somewhere next week. We should, because typically when we are approaching earnings, typically implied volatility would increase on that expiration date. So again, if they change the date of earnings, that number will never increase that much more. And then, we'll do another roll, we'll mitigate the risk, but probably the trade will not look too good unless the stock rallies. And then we'll end up in a profit. If not, it's going to be a small loss. But if that date is not changed and implied volatility rallies, then we are set for a very high probability opportunity where the outcome would be a profit. So again, it all depends on those moving factors, and therefore you guys need to be watching this because earnings is approaching and this is the end of the trade. Okay, so you have homework to do here with Nucor into next week. Observe all of this. Observe this. The option chain every day is going to be a great learning experience. Okay, cool. Next trade, speed of the light, IBM. This trade expired on the 30th. Okay, so this trade actually ended up as a profit. I mean, if you look at, let me go back here. If you look at TOS, I don't have it. Why? Because it's expired. If you look at the chart, it does not look as a profit, but it is a profit. Let me explain why. So if you look at the chart, IBM closed right here on the Friday. Okay, that was September 30th. That was Friday. The closing price was 118.81. 118.81. The options we were using on this trade were 120 and 119. Okay, 120 and 119, right? So they were both in the money at the time. So it was assignment and auto exercise. Okay, so if you look at the theoretical performance of the trade, we lost 82, but that is if you did nothing. Okay, which, as that market was going down, and if I go back in time, as the market was going down aggressively, okay, starting on that day, it was time to start rolling, okay, all the way to here, okay, bringing those calls from here all the way to here. And again, we talked about this, I believe, if I'm not mistaken. And again, I looked into it. I didn't credit it, so I cannot show you in the screen, but I did look into it. And given the premiums available at the times of the various rolls, because this was happening in multiple days in a row, as that stock was continuing going down and our red line was crossing the bottom purple line. So those multiple rolls would have brought in enough premium for this trade to end up as a profit. The trade was never converted into iron butterfly. It was from condor to narrower condor to narrower condor to narrower condor to end up as a profit. Okay, but unfortunately I cannot show it to you since the trade concluded last week and we did not have a session last week. And the last one is Amazon. For the ones of you that are watching this session and you are new to our community, something that needs to be clearly understood about options trading, and for the ones of you that are the usual attendees, I guess it's totally understood and well understood, which is the fact that options are great as an asset, and in a way they put you at an advantage. It's great. But the real advantage comes with the trade management. A good options trader doesn't put a trade in the market and does nothing about it. I mean, yes, if you are impeccable at catching market direction and you run a very limited amount of trades and you are just focusing on directional strategies and you enter at your entry and your targets are far enough to generate reward to ratios that are decent and all of that. So yes, you can just set options trades and forget about them. No problem. But if you want to be more active, you want to have a diversified portfolio, if you want to hedge and all of this, you have to end up massaging your trades. And a key ingredient of success and consistency in options trading is to knowing how to deal with your trades during the life of the trade. And that's why I spend so much time discussing trade management, guys. Let's see. Mark, next rule on Nucor is to different strikes, one strike above for the call and one strike below for the put. You are correct. You are absolutely correct, because the next expiration date is when we take the double diagonal and we make it a double calendar. Very good, Mark. Now, Amazon. What do we have with Amazon? Similar experience compared to Nucor. Okay, that stock started, we entered here, went up, and then it went down aggressively. Okay, and because I did nothing into last week, okay, I'm supposed to be in that position where you can see those September expiration options, which of course, if I look at the risk profile like before, they won't be there, they will be gone, because September 30 does not exist anymore. But if I look at my TOS, then you can see what happened with the put I used to have. Well, because I was short a put at 121, that put became 100 shares of stock long at 121. Same case as what we had with Nucor. Okay. So, well, since it's the very same case, let's go ahead and approach it in the same manner. So first of all, I'm going to edit this. I'm going to add 2 more legs. These are going to be to sell options. These are going to be using October 14 expiration. These are going to be using the midpoint. Put and call, where the put is 121 and the call is 139. Here we go. So if I do that, first of all, let's look at the call, which is the easy one. What do we get? It looks like only 6 cents. Nothing. So what I'm going to do, again, copy paste from what I had before on Nucor. I'm going to go for Amazon. I'm going to look at October 14. We're looking at the 139 call. And again, I'm moving fast, guys. We've done this before. Hopefully it's fine. So 15 cents, good till cancel. I'm just placing the order. I won't get filled. But this order, together with the one of Nucor, we're going to be waiting to get filled here on the top in case there is a rally on the price of that stock. And then we get some premium in to help a little bit the call side. Great. Now, so for the put side, what are we going to do? Well, for the put side, what we're going to do is we're going to close the shares. Okay. Now, the current price of the stock is about 121, and we got assigned at 121. So, to be honest, if I close it now, I make nothing, I lose nothing. I'm sure Mark is very happy about this one. Isn't it, Mark? Just having a little bit of, funny or less funny humor, okay? Because we talked about it. It's not that relevant. But anyway, so in this case, I think it's a beautiful example where the stock went exactly to where you wanted it to be, not to add a loss. Okay. So what are we going to do apart from closing the stock? Well, we're going to be selling a put. Okay. Which put? The 121, which that one is going to pay $300. Okay. $300. So let's do it. I'm going to go ahead and right click, close the stock. The bid and the ask, 7 to 8 cents. So let's not waste our time. It's very liquid. So I'm just going to go for market, close the stock at market, and immediately sell the 121 put that expires at 14 at 320. Let's see if we get 320. I just got filled at 345. Beautiful. So I got 345 and the stock I got filled at 120.57. Okay, that's what I got. Okay, so I guess that you can see how the values are. it's funny, you know, and another confirmation of what I said before. This was 320. This was 121. But because you know, this is a simulated account, so there is a bit of delay data, as you can see on the upper left, right? So the real-time pricing was different than what, you know, I saw on the screen. So guess what? Because I got a bit less on the stock, I got a bit more on the put. And if you do the math, you kind of feel, isn't it, that it's about the same. It's not that big as a difference, isn't it? So yeah, so that's what it is. So great exercise doing this together. So anyway, so we got the stock at we got rid of the stock at 120.57, and we got the stock at 121. So we lost 43 cents on the stock, while we got $3.45 on the put. That equals $3.02 of premium. So going back to top, if you look at how much I had accumulated on the put side, I had 318. That's what I had on the put side. So now I am just adding 302 to 318, and that therefore becomes 6.2. So if I update my simulation, my put is now 6.2, and my call is 69 cents. That's what I had. So I'm going to add 69 cents to the call. Okay, so what happens if I do that? Well, if I do that, I am left in a position where we are, the worst case, we're going to lose 200. And currently we're making 141.5. So this trade is ahead of the game. And worst case, again, this was a trade I saw that when we started, it was like close to $1,000 of risk. So now we only got $200 of risk left. Now, looking good. Well, let's keep analyzing what's going on. Okay? Always skeptical. Okay? Always skeptical to be safe. So, let me close this and this. So we are using October 28th expiration, and notice how the earnings is happening just a bit before. Great. They have not changed the date. 10/27. Okay, that's the earnings date, and 10/28 is the expiration. Looking good. Volatility has indeed expanded. Okay, so since we entered the trade, volatility has gone higher, but we may get even higher. The last time we got earnings, okay, it went as high as this. Okay, so there is room for volatility to keep rising. So therefore, if I go back to simulating this trade, risk graph. So notice what's going to happen to the risk graph if volatility rises a bit more. Okay, the risk graph is going to go higher. So depending on where the stock is on the expiration date, we can make $400, $500 per contract, which is one more than 143. And the risk is only 200. And next week we're going to roll, and the next week we're going to roll. Expiration is on the 28th. So certainly, in my mind, it makes a lot of sense to do nothing about it and just keep the trade the way it is and just keep massaging the trade every week. There is no problem, okay? It's all good. Cool. So I'm going to take a sip of water. I'd love to hear some feedback from you, some confirmation that all is understood, and we're going to continue now. Mark, but I definitely like not losing money on the shares. Yeah, I got you. But the money you lose on the shares is extra premium you get when you sell the put, right? So I guess it's probably a psychological thing that bothers you there. But, you know, the math is the math, okay? So just keep that in mind. And by the way, if this is something that really bothers you, so again, you can maybe create some sort of a rule around it. Maybe you identify, you look at the climate on a lower time frame, and you try to write a climate in a lower time frame to try to get rid of the shares as high as possible. You can do things like that, but again, I made my point earlier. You're probably going to overcomplicate and get frustrated when, even though you were doing some intraday management, in the end the market is the boss and did whatever it wanted to do that day, and you did not achieve your goal, and you ended up not doing anything about it, and then you missed on premium. And yeah, you did not add risk, but you did not reduce risk. Okay, cool. Okay, friends, I'm really struggling with my voice. I'm sorry about that. Give me a moment, guys. Got you, Mark. I understand. Cool. Okay, so let's continue. Now, we got 10 minutes to go. Okay, it's gonna be tough. Let's try to find a trade in 10 minutes. So we're gonna be looking for iron condors, so looking for high implied volatility. We are gonna be looking at nothing on the stock filters, scan list, penny increment options. We look for neutrality, so neutral daily, neutral weekly, yes. Earnings, exclude 15 days, and nothing auto climate. Okay, great. Okay, so let's scan. So we got a few stocks. So let's take a look at CVS. Looks good to me to take a look at the trade. Okay, definitely it seems that implied volatility is quite wide, and because earnings is there, we can use up to October 28. So I'm loading the spread select tool. I do need to do this fast. Okay, so CVS. Looking for a short iron condor. I want to look at 14, 21, 28. More than 28 I cannot. And minimum, we're going to do 1. That stock is a $99 stock, so I'll do 1 to 2 maximum. And we're going to use the filters, load my template for iron condor. Okay. And then we're going to build 99 spreads and see which ones pass and which ones don't. Okay, so we have a few passes using October 14. So let's take a look at October 14. Red line on October 14 is 104.94. So do we have 104? We have 104, and that's October 21st. Okay, so October 21st is 106.92. So October 21st, we are looking at 106. 106. No 106, and then we move into October 28. So it looks like with CVS, if any, October 28 is going to be the one. So October 28 right here would be the red line 108.91. So let's look at 108. No 108s. 106s. No 108. Okay, so CVS doesn't pass. Okay, so what was the next one in the list? The next one in the list is Texas Instruments. Let's take a look. Okay, so here we can go all the way to October 21st. So TXN, we're gonna do 21st, 14, no 28, We're gonna do minimum $1, maximum $2. Okay, so on the 14 we have passes. So let's take a look at the 14, what the range would be. 178. So let's see if we find 78. 178 right here, and 159. Okay, so 178 and 157. So no good. 178 and 151. That's October 21st. Okay, so almost there with October 14. Almost, very close, but we don't. Okay, so let's sort. So with October 21st, we will need the range to be 182.53. So 183. Okay, we got 183. What about the bottom part? I don't think that one is going to work. The bottom part needs to be 153, and this is 156. Okay, so the bottom part doesn't work. Okay, that one doesn't. Sorry, that one doesn't. That one does. Okay, so no good with Texas Instruments. Next one is Textron. Okay, I'm gonna pass on this one. No weekly expression dates. So 4 minutes to go. Let's see if I find at least one. CIB mean above, the 2-star deviation. So CVS and PayPal. Let's take a look at PayPal. PayPal is good, all the way to 11.11. Okay, so let's take a look. 1 to 2. Okay, so with October 14 we have passes. October 14 allows 104.85. Wait a minute. Dangerous me. I didn't change the symbol. Oh, sorry, PayPal. Dangerous me. Sorry about that. 1 to 2. Okay. So we've got the top should be 104.85. We got 98, 103, 104. So 104.86. We said 104. 104.85. Almost. $104.87. $105.86. 86, 86, 86, and this is October 21st. Okay, so October 14 is very, very close, guys. If the market was to get a bit excited and start moving to the downside, it's looking like if you watch these trades, one of those may now provide premium enough to pass our rule. Okay, October 21st is likely not going to, because the monthlies always have less premium, not always, but almost always. 107. Let me see if we get 107. No 107 so far. Yeah, so we get into 108. We get into 28. Yeah, I did mention that before in prior sessions. Okay, October 28. Let's see what that would be. October 28 would be here. That is 110 and 79. 116. Wow. Where's the catch? What? There is no catch. Liquidity seems okay. Okay, let's graph it. We said 110. So we got 111.81. Liquidity is valid. We got 111.83. This one seems to be the best so far. $111.84. This one is even better. Wait a moment. Okay. $5. $5. $5. Yeah, so 1 or 2 strikes is actually putting me at $5 on that expiration date. Okay, 111.84. That is also valid, also on October 28th. And sorry guys, I'm not looking at the chat box because I'm trying to find a trade. But I'm going to check in a moment, okay? 111.78, and that's November 4. Okay, so I'm going to stop here. So we got those various possibilities. So risking 371 to make 129, risking 380 to make 119, that's worse. Risking 399 to make 100, that's worse. Risking 396 to make 104, that's worse. And therefore the winner is this one. And now we need to go ahead and work on the chart to confirm the trade. So it's 2 minutes above the top of the hour. Okay, I'm just gonna complete this, okay, as quick as I can. So 28 is here. Here we go. 28 is here. Here we go. So we're gonna move to a lower time frame. Look for 2 UFOs above, 2 UFOs below. 42% probability, I'm not gonna take it. 89. Loading. Mark, going wider with the strikes increases the risk. Okay, so that's why. 44, so not gonna work well, so I'm gonna go lower time frames. 34, 21. Wow. That I was not expecting to see such low probabilities on PayPal intraday. Crazy low institutional interest on that stock. I'm looking for timeframes that produce 48% or more. What number is that? I can't read it. Funny, isn't it? Don't show the labels. 42%. Okay. So 42% is not good. So I'm gonna go back to lower time frames. Level 13. What about 8? This is so strange. You know what? I think I may have saved from the last time pre-market data. Oh yes, that's what it is. I'm like, this is a very, very strange. Okay, let's go ahead and restart here with 55 minutes. Okay, that was silly me. Okay, so here's the red line, and here's the first UFO, and we indeed have multiple UFOs there on top of each other, so that's good. And on the bottom part, we also have one here. Now it's not exactly equal distance. To be honest, I like to go here. It's not exactly equal distance. So if I have an opportunity to go a bit higher, I would like to examine that. This is, I would say, too much higher. So let me drop to a lower time frame and see if I have some UFOs somewhere in between, so I can have my purple line to be as well centered as possible. So this is better. 21. That's what it is. So let's look at daily. Yeah. So I guess we're gonna do this. Okay. This is gonna be the range. Okay. Good. So this is where we enter. This is our profit zone, and we got the purple lines for trade management purposes. Okay. Now the trade to be executed is with the 81.86, 110, 115. That is PayPal using October 20 expiration. This trade got $370 of risk, assuming you get filled at the midpoints. So PYPL. Looking at October 28, we're gonna sell narrow condor, and the call side is made of 115, 110. $110, $115, and the put side is made of 81.86. This is supposed to create a credit of 126, so I'm just going to place an order. See if I get filled efficiently. Just got filled. Great. So I'm going to place a line here and here so we know when we enter the trade. And I also need to document this before I have it on my positions panel. So what did we get? So we got on the put side 203, 110. So on the put side 203, 110. And on the call side 73.37. Okay, creating that $129 of premium collected on this trade. And I'm going to copy this to the positions panel. I know I went at the speed of the light. Let me put the information on the screen now that I have copied it here, and then I've done my homework, if you wish. Let me put that on the screen so you can at least take a screenshot if I went too fast. So as the session is over, you can review or practice this trade, rebuild it yourself, practice your trade. Maybe this is handy for you. In the meantime, while I have this on the screen, I will take a look at the chat box. Yes, so Mark, I did answer that, isn't it? I did answer your comment there. What do you mean about the range? Okay, everybody. So I believe that, well, we extended the session by a bit. I apologize for that. We got our trade, which is good. I'm always very happy to get trades in. So I give you food for practice. And also it gives me food for demonstration in future sessions when we talk about trade management, which is absolutely key. Okay, so got the trades in the account. We had our session today. It was my pleasure. I missed you last week, my friends. See you soon. and keep up the good work, everybody. If you need anything, guys, we are one message, one email away. The question section in our website, you name it. So make sure you are in touch. Don't stay isolated, guys. Okay, we're in this together. Take care, everybody. Bye bye. See you soon.